July, petroleum prices on import prices, X, were up 1/10, much less than expected. The headline number for import prices was up 0.3. So we could see petroleum played a big factor there. But here's where the numbers start to get interesting. Import prices year over year up 10.2%. Remember, 11.6 from a couple of months ago was a 10-year high. So these are sticky once again. And if we go to export side of the equation, export prices month over month were up 1.3, stronger than expected. So the imports were on the weak side on the month over month, and ex-petroleum exports, not so much. And if we look at year over year export prices at 17.2, that is very close to 17.5 from May, which was the all-time high going back to 1984. So we see export prices are a bit sticky, import prices not so much. And that's interesting because we are definitely importing much more aggressively. Think trade deficit. So the fact that we are importing things that aren't necessarily as pricey maybe gives some people confidence with regard to the pricing issues we all know that are coming or here to some extent. And we also know that on the inflation front, makes it very difficult to trade things like fixed income markets. One day the market's selling off thinking inflation's down the road, even if it's sticky. The next day, many don't show up for auctions thinking after a hot PPI and CPI, maybe they've misjudged. Look for that back and forth to continue. And what's noteworthy here is that if we continue to monitor interest rates, they have snugged up rather dramatically. Any type of yield close in 10s over the next 2 or 3 weeks that has a 1.4 in it, I would look to see much more aggressive selling coming in. Andrew, back to you.
Rick Santelli, have a great weekend, my friend.